If you've ever been told by a bank or a credit union that you need to reduce your write offs as a self employed business owner in order to qualify for a home loan, I'm here to tell you that you've absolutely been lied to. For those of you who don't know, my name is Aaron Page. I'm a mortgage broker. I've been in the lending industry and the real estate industry for 14 years. So at this point, I know a thing or two about loans and how to make these things work. Let me tell you the number one thing that I've seen over my career where I find out that most people have been lied to, and not necessarily lied to in a malicious way. It's just from an education standpoint, the person they're working with doesn't have the knowledge and the education of loan programs that are out there. So here's an example. You're a business owner, self-employed, you've been a business owner for 10 years, you make $200,000 a year, you write off $100,000 on your taxes, leaving you after write-offs, deductions, marketing expenses, meals and entertainment, the whole shebang, you have $100,000 left over. $100,000 may work for qualifying, but Fannie Mae and Freddie Mac will dictate all of your write-offs that are deducted out. Some of it gets added back in, like mileage on a vehicle, but for most expenses, it's deducted off your top line to make your bottom line at $100,000. Now, $100,000, when you break that out monthly, may get you what you want when it comes to buying a home or your real estate goals. But if your goal is to buy as many properties as you can, or buy bigger properties, or have a more luxurious home, whatever the scenario is, it doesn't matter to me. $100,000 may do that, but here's a loan program where you don't have to worry about reducing your tax liability if you do want to qualify for more than what the bank is currently telling you. The loan is called a bank statement loan, and we don't get tax returns at all. So if you go to do a conventional loan, you have to provide 2 years of tax returns, and Fannie Mae and Freddie Mac have a worksheet that dictate what gets subtracted, what gets added back in, like we already touched on. So I'll save you the runaround on that, but conventional guidelines use your tax returns in order to qualify, taking out your expenses. Let's say in order to qualify, because you're a business owner, you have some debts and your debt to income ratio is going to be over, and $100,000 isn't enough to qualify for what you want to do. Which, with the way real estate prices are today, $100,000 doesn't go as far as you would think. A bank statement loan comes into play because we add up all deposits over a 12-month period. So you send me 12 months of bank statements for your business. I'm going to go through and add up all deposits over that 12-month window. Let's just say, for easy numbers here, that number is $200,000, the same one we're talking about that's appearing on your tax returns. We take the $200,000 and we take out a 25% expense factor right off the top, because we do assume nobody works straight dollar for dollar. There's always some kind of expense in some capacity in almost every business. So that takes us from $200,000 down to $150,000 when we take out that 25%. Now that we're down to $150,000, we take that number and divide it by 12, which comes out to be $12,500. That's your usable income with no tax returns provided on a bank statement loan. Now, in our tax return scenario, if you had $100,000 divided by 12, that's $8,333. So by utilizing a bank statement loan, you're actually getting $4,000 more per month in income without providing your tax returns and achieving your real estate goals a little bit quicker with more income on paper. Now, here's the sticking point for everybody. Everyone always says, yeah, that's great, Aaron, but a bank statement loan has a higher interest rate than a conventional loan, and nobody's denying that. I'm not denying it. If anybody ever says a bank statement loan and a conventional loan have the exact same interest rate, I can tell you they're lying to you. I've done it this long enough to know that will never happen. But let's say you take the advice of the bank or credit union that you're talking to, and they say, hey, you make $200,000, you write off $100,000. If you want to qualify for this, you need to reduce your tax write-offs to basically nothing. You need to show $200,000 of income to hit the goals that you want to hit. You say, okay, got it. Writing off $100,000, on average, your federal tax liability that you would have written a check to the IRS for would be just a little over $15,000. If you, in order to qualify, have to stop all of your write-offs entirely, and now on paper on your tax returns are showing $200,000 of income with no write-offs, your tax liability is now, on average, over $41,000. So that's a $26,000 difference between the two by reducing your write-offs. So the main question is this. If a bank statement loan interest rate is a half a point higher, maybe that comes out, let's be super aggressive and say that's $500 a month more in interest on your mortgage. To have a half a point higher rate on a bank statement loan versus conventional comes out to $6,000 a year. You can already see where I'm going with this. If you need to qualify for more, use a bank statement loan. Pay $6,000 more a year in interest, because the difference in your taxes is either $15,000 or $41,000 to do a conventional loan just to save a half a point in interest and $6,000 a year. To save that $6,000 a year on paper because you don't like the interest rate on a bank statement loan is going to cost you $26,000 more in tax liability to achieve your real estate goals. So why not just pay a little bit more mortgage interest and not pay more to the IRS? It seems straightforward, it seems simple, but you'd be surprised how many people don't actually know that this is a thing. There's a quick down and dirty overview of a bank statement loan versus conventional. If you guys found this information helpful, make sure you subscribe to the channel, share this with anybody who you think might find it helpful, and we'll see you on the next one.